Good afternoon. Thank you for joining the AI Insight webinar, Introduction to Opportunity Zones. I'd like to start by introducing Mike Kell. Mike is the Senior Vice President of Program Management and Business Development. Mike?
Hey, Jen, thank you very much. And first off, I just want to start by thanking everybody for taking the time out of the day to join us today to speak about opportunity zones. Real quick, AI Insight, research, training, education, compliance documentation firm, really focused on both illiquid and liquid alternative investments. For those of you that are current subscribers, we certainly appreciate your relationship. For those of you who are not, you can learn everything you need to know at AIinsight.com, and as well as how to get in contact with us for further information. This is the first of our webinar series that we're going to have this year. We're going to do one a month, 30 to 60 minutes on all kinds of different relevant topics, as well as topics about how to best use the platform to get out of it what you need. And very quickly, our next webinar is Thursday, February 28th, 4 o'clock Eastern, panel format on alternative mutual funds, which is a great new initiative of ours this year to really discuss the complexities and the regulatory focus around them and the solutions that we provide. But ultimately, the focus today is the opportunity zones. A couple of quick points to make of resources that we have available through the platform. First of all, publicly available information on our website, AIinsight.com. Within our blog, you can find a QOZ FAQ with all kinds of relevant information and links to learn more information. We recently launched a CE credit qualified for CFP credit webinar, or excuse me, a CE course that you can access. You can learn more about it on the site. Once you get logged into the site, you can take that course and very comprehensive information with anything and everything to do with opportunity zones, so great value there. And then another item is we're partnering with the IPA to bring a QOZ forum to Dallas on February 12th and 13th. It's a sold-out event. We look forward to seeing everybody there who's already registered. Fully focused on nothing more than education around these, which is going to be a great thing. And then lastly, I'd like to mention that we've been hearing for a long time all these different opportunity zone funds coming. Every day you see a new one in the news, but you don't really see much more information. I'm happy to say that we have two of the first funds. They're actually in entry right now. We're waiting to get the final thumbs up to activate them in the platform. So those of you who are subscribers, I would expect very soon you'll see some activation notifications of those going live in the platform, and I would highly encourage you to get in there, click on them, take a look, kick the tires, learn more about it. Whether you're interested in that particular program or not, I think there's a lot of great information to learn, especially around the risk factors, benefits, investment objectives, what they're doing, how they're doing it, controls that are in place, et cetera. So I highly encourage you to get in there and click around and learn more about those. With no further ado, I'd really like to shift gears here and really get into the meat of the presentation. It's short and to the point. I think we have a lot of great content to cover in a very short period of time. I'd like to say that we have two individuals that are going to present today on behalf of Mick Law, who most of you are aware of, but ultimately they're a law firm that specializes in third-party due diligence, in all kinds of alternative investments and many other services. But ultimately, Kyla Ehrisman, who we worked with on that CE course and provided all the content that went into that CE course. She's the main point of contact at Mick Law for anything and everything to do with opportunity zones. Attorney, MBA, very, very intelligent individual. We're happy to have her. She's going to cover most of the content today. And then we also have Alan Lincoln, MBA, as well. He's really the main underwriter that Mick Law uses for all their real estate deals. Has been doing it over there for over 12 years. So we're really excited to have him on, not just to provide his expertise, but I think something that's going to be interesting on this particular call is the fact that we're going to walk through a case study together and in actual examples with some IRR calculations and impact, doing that investment through an opportunity zone or a real estate-based opportunity zone fund. So with no further ado, Kyla, it's all yours. Thank you.
Thanks for that introduction, Mike. For the next 20 minutes or so, I'll be giving a brief overview of opportunity zones and opportunity funds. Since this is a new and developing area, we've got a lot of ground to cover. After that overview, Alan will take over to go through a case study which illustrates how the potential tax benefits associated with opportunity funds can benefit investors. After that, we'll wrap up with a few takeaway points and then have a little bit of Q&A. So, starting out, what are opportunity zones and opportunity funds? The Tax Cut and Jobs Act of 2017 added Section 1400Z to the Internal Revenue Code to incentivize long-term private sector investment in low-income communities by enabling states, the District of Columbia, U.S. Possessions, and Puerto Rico to designate certain low-income tracts as opportunity zones. The goal here is to drive long-term capital to distressed communities by providing tax benefits on investments in qualified opportunity funds. So let's take a quick look at each of those defined phrases. An opportunity zone is a census tract which has been designated by the governor of its state as eligible to receive private investments through opportunity funds. Per state or territory, up to 25% of the total number of low-income census tracts could be designated as an opportunity zone. So, for example, if a state has 200 low-income census tracts, up to 50 could be designated as opportunity zones. The states went through a process of submitting their recommendations to the Department of the Treasury, which could either approve the recommendations or provide feedback. Every state and territory nominated its census tracts for Opportunity Zone designation, and as of June 18, 2018, all submissions had been approved. In total, there are 8,762 opportunity zones, and they cover approximately 11% of the U.S.'s geographic area. Moving on to our next definition, an opportunity fund is a private investment vehicle certified by the Treasury to aggregate and deploy capital in opportunity zones for eligible uses that are defined as opportunity zone property. Opportunity funds can be organized as partnerships, corporations, or LLCs. Pre-existing entities can be used as opportunity funds. However, any investment made into a pre-existing entity before it qualified as an opportunity fund will not be eligible for the tax benefits of opportunity funds. Funds seeking to be designated as opportunity funds will self-certify by filing the newly created Form 8996 with the IRS. The statute does not limit the number of opportunity funds that can be created, nor does it provide instruction on the nature of investments. There's also no cap on fund size or investment size. Opportunity funds are required to hold at least 90% of their assets in opportunity zone property. This percentage of assets will be measured twice yearly, at the 6-month mark of the taxable year, as well as the last day of the taxable year. So if a fund uses the calendar year as its taxable year, the 90% asset tests would be done on June 30th and December 31st. Funds that fail to meet the 90% asset requirement are subject to penalties for each month in which they fail to meet that standard. One major concern before the first round of proposed regulations were released was the ability of real estate funds to meet this asset requirement within 6 months, since these funds generally require more than 6 months to complete acquisition or development activities. The regulations addressed this concern by adopting a working capital safe harbor provision. The safe harbor allows opportunity zone businesses to count uninvested funds toward the 90% asset requirement for up to 31 months if 3 criteria were met. First, there must be a written plan that identifies the uninvested funds as property held for the acquisition, construction, or substantial improvement of property in the opportunity zone. Second, there must be a written schedule showing that the funds will be used within 31 months. And finally, the business must substantially comply with the schedule. The proposed regulations also provide that an opportunity fund has a reasonable period of time to reinvest proceeds from disposition of property and remain in compliance with the 90% asset requirement. What this means is that opportunity funds will have the option to engage in multiple cycles of development and disposition during the 10-year hold period by selling assets and reinvesting the proceeds in new opportunity zone property. It's expected that the next round of regulations will provide further guidance on the reinvestment option and requirements. Opportunity zone property generally falls into two categories: directly held tangible property that's used in a trade or business, or ownership interests in a subsidiary entity which qualifies as an opportunity zone business. The first type of property, directly held tangible property that's used in a trade or business of the Opportunity Fund, must meet three requirements to qualify as Opportunity Zone property. First, such property must be acquired by purchase after December 31st, 2017. Second, the original use of the property in the Opportunity Zone must commence with the Opportunity Fund, or the Opportunity Fund must substantially improve the property. And third, during substantially all of the Opportunity Fund's holding period for such property, substantially all of the use of such property was in an Opportunity Zone. The second type of Opportunity Zone property, stock in a corporation or an interest in a partnership, must meet the following requirements. First, such stock must be acquired by the Opportunity Fund after December 31st, 2017. Second, as of the time such stock is acquired, the entity must be a qualified Opportunity Zone business. And third, during substantially all of the fund's holding period for such stock or interest, the entity must qualify as a qualified Opportunity Zone business. For a business to become an Opportunity Zone business, it must meet certain requirements. At least 50% of the gross income from the business must be from the active conduct of a trade or business, and that active conduct in the trade or business must be taking place in an Opportunity Zone. As a note, this instance of substantial portion has not yet been defined by the regulations. And finally, less than 5% of the property of the business can be non-qualified financial property. Additionally, Opportunity Zone businesses cannot be sin businesses, meaning no golf courses, country clubs, massage parlors, hot tub facilities, suntan facilities, racetracks, or liquor stores. Real property that's purchased by an Opportunity Fund will need to comply with the substantial improvement mechanism via an alternative option. Real property within an Opportunity Zone will constitute qualified Opportunity Zone business property if within 30 months of buying the property, the business spends more to improve the property than it did to buy the property. The proposed regulations also specify that if the business is improving a building, the basis in the land will be excluded from the calculation of how much was spent to purchase the property, and therefore how much must be invested to be considered substantially improved. Moving on to our next slide, there are basically two current sources of regulatory guidance regarding Opportunity Funds. First, there is the original statute, Internal Revenue Code, Section 1400Z. Next, on October 19, 2018, the Treasury released its first set of proposed guidelines, which totaled a little over 70 pages and were the first in-depth look into how Opportunity Funds will operate. The Treasury also expected to release a second set of proposed guidelines before the end of 2018, but this was delayed and then further delayed due to the partial government shutdown, and these further proposed guidelines are now expected in March of this year at the earliest, barring any additional shutdown issues. Moving on, there are several potential tax benefits associated with an Opportunity Fund investment. If a taxpayer realizes a gain from the sale or exchange of a capital asset to an unrelated party, the taxpayer must invest in an Opportunity Fund within 180 days after the disposition to be eligible for the program's tax incentives. Eligible taxpayers include more than only individuals. C corporations, S corporations, partnerships, trusts, estates, regulated investment companies, and real estate investment trusts, are all eligible to defer recognition of capital gains through Opportunity Fund investments. In addition, the owners of these entities have the option to defer their individual portion of gains if the entity chooses not to defer at the business level. The tax deferral benefit of Opportunity Fund investments is not automatic. A taxpayer must elect on his, her, or its tax return to defer the gain using the newly created Form 8949. A wide variety of gains can be used to facilitate an Opportunity Fund investment. There is no like-kind requirement like the one found in 1031 exchanges. Gains from the sale of any type of property that produces capital gains can be deferred if properly invested in an Opportunity Fund, meaning that an investor could use gains from the sale of shares of stock, a piece of land, a business, or capital gains dividends from a REIT, among others, to invest in an Opportunity Fund and defer payment of taxes on those gains. As a note, while investors are free to invest any amount in an Opportunity Fund, the portion of an Opportunity Fund investment that is invested in excess of the capital gain amount is not eligible for any of the tax benefits associated with Opportunity Fund investments. The first tax incentive is deferral of the original tax bill on capital gains. Investors can defer their original tax bill until December 31st, 2026 at the latest, or until they sell their Opportunity Fund investments if earlier. The next tax incentive is a set of basis step-ups on the original deferred gain based on the length of time the Opportunity Fund investment is held. If investors hold their Opportunity Fund investments for 5 years, the basis of their original investment is increased by 10% of the amount of deferred capital gains, meaning they will only owe taxes on 90% of the remaining rolled over gains. If investors hold the Opportunity Fund investment for a total of 7 years, the basis increases by an additional 5% of the amount of deferred capital gains. As a note, due to the timing requirements of this provision, Opportunity Fund investments must be made by December 31st, 2019 to be eligible for the entire 15% basis increase before the tax bill on the original investment is due. The final tax incentive is the complete exclusion from taxable income of capital gains on Opportunity Fund investments held for at least 10 years. What this means is that if an investor holds its investment in an Opportunity Fund for 10 years, the investor can elect to have the basis of the investment equal the fair market value of the investment as of the date of sale or exchange. In other words, after settling their original tax bill, investors in Opportunity Funds who maintain their investment for 10 years will face no capital gains taxes on the Opportunity Zone investment when disposed. The recently released proposed regulations provide that taxpayers will have the ability to make this election at any point between reaching the 10-year hold period until December 31st, 2047. Our next slide has a few important dates to know in relation to Opportunity Funds. The first is February 14th, 2019. It was just announced yesterday that the hearing that was supposed to be held on January 10th regarding the proposed regulations that was postponed due to the shutdown will now be held on February 14th. Given the government is currently funded through February 15th, this date shouldn't be affected by further shutdowns. December 31st, 2019 is the next important date to know, as this is the date that investors need to make their investments in Opportunity Funds in order to ensure they get the benefit of the full 15% basis step-up. The next bullet isn't a specific date, but rather a window. Investors must reinvest their capital gains into an Opportunity Fund within 180 days of recognition in order to be eligible for the Opportunity Fund tax benefits. December 31st, 2026 is the final important date on the list, as this is the date on which investors will have to recognize the originally deferred gains and pay that tax bill. Before I give Alan the reins, we're going to briefly cover some of the risks associated with Opportunity Fund investments. First, given that the Opportunity Zones program is newly created and no final regulations have yet been issued, such issuance may impact recently created funds in unanticipated ways. While the IRS has released proposed regulations regarding Opportunity Zones, These regulations are not complete and do not address all aspects of opportunity zones. Further regulations are expected in March at the earliest, and such additional guidance may impact opportunity funds investment strategies, or such guidance could make some or all of a fund's planned investments ineligible for the tax benefits and could result in the requirement that an investor immediately pay taxes on gains that were deferred in expectation that a fund would qualify as an opportunity fund. The lengthy holding period also creates risks for investors. An investment in an opportunity fund is illiquid due to the 10-year required hold period, and this hold period may require sales at inopportune times and result in less than maximum returns on a particular investment. Relatedly, if an opportunity fund liquidates prior to the completion of the 10-year hold, investors will not receive a stepped-up basis in the opportunity fund investment, and depending on the timing of that liquidation, they could face an immediate tax bill. For example, if the opportunity fund were to liquidate after 6 years, an investor would face an immediate tax bill on its original capital gains that were deferred. Investors who opt to timely invest in an opportunity fund will be required to pay tax on such deferred gains as of December 31st, 2026. The opportunity fund may not have sufficient cash flow to make a distribution at that time, or fund management may decide not to make such a distribution. Taxes will be due by investors at that time regardless, and failure to pay such taxes could result in interest and penalties due to the IRS. The 90% asset test also poses several risks to investors. In the event that a fund is unable to meet or maintain that 90% asset requirement, investors would be responsible for a penalty which the fund may or may not be in a position to make distributions to cover. In addition, in order for an opportunity fund to count its working capital toward the 90% asset test, it must have a written plan in place that meets certain requirements and deploy the capital within the first 30 months of operations. If an opportunity fund is operating as a blind pool fund, there's a risk that it won't be able to source enough acceptable investments in a timely fashion in order to comply with these requirements. At this point, I'm going to turn it over to Alan to walk us through a case study showing the tax benefits of an opportunity fund investment in action.
Thanks, Kyla. Just a simple case study we wanted to walk through today. This is an investor who has $10 million of real property gain to reinvest. We're only worried about the gain here. As Kyla mentioned earlier, the investment made in excess of the deferred gain is not eligible for the OZ tax treatment, opportunity zone tax treatment, so we're only concerned about those gains. You had a $20 million asset, you had a $10 million basis in it, and you had $10 million for the gain to reinvest. We've set the purchase price at that $10 million number, again, just to keep the number simple and easy to understand. We've shown a return of 10%. I just noticed here in my notes, I've got a 3% escalation factor when in actuality, the slides you're going to see on the next page is going to show a 2.5% escalation. I toyed with that one just a little bit for numbers to make the numbers work out right. 100% of that, again, 100% of that $10 million is invested as a deferred capital gain. That would result in a $0 basis within the opportunity fund or a $10 million basis outside of an opportunity fund. So that's an investment made without real property gain. We're just making a $10 million cash investment. We've shown a disposition price at $12 million. That's 10 years from now, or in 2028, to meet the 10-year holding period. And just for the purposes of this analysis, we've assumed a depreciation period of 27.5 years, so it's a residential asset as opposed to a commercial asset, which would be 39 years. On the next slide, it just kind of starts to walk through the case study. I'll point out a couple of numbers that are significant here. This shows the entire 10-year period. We've got the $10 million investment in that asset shown. We have no tax due upon the initial investment. The NOI, or the annual return, is at $1 million. That 10% I talked about escalated at 2.5% per year. In 2026, or year 8 of this investment, you'll see a tax due of $1.7 million. That's the result of that step up in basis that occurs twice. As Kyla mentioned earlier, it's 10% after 5 years and 5% after the 5% of additional at the 7-year mark. So we've shown that as a $1.7 million payment at the beginning of year 8, or after the end of the 7-year period, December 31st, 2026. Then we show disposition price at $12 million. There's no tax due upon the sale. I point that out just to, again, reiterate the point that these opportunity zone funds can appreciate, or the funds can appreciate in value and result in no tax due. On the next slide is a balance of the case study shown, or I guess is a summary of that case study shown. Again, we got that 10% step up in basis, the additional 5%. And we've got that tax liability due on the 85% of the remaining basis, or the $8.5 million, as a 20% capital gains tax rate, and so we've resulted in a $1.7 million tax liability. That all results in an IRR. If you crank through the math, that's an IRR of 10.92%. Just for comparison, on the next slide, we've got the cash flows from an investment made outside of an opportunity zone. In order to represent the difference between a tax due upon the initial investment, so we're talking about a capital gains tax due on that $10 million, a 20% capital gains tax due, that would be, you can think about it either way. It's either avoided within an opportunity zone, or you have to pay it outside of an opportunity zone. So our basis in this asset, or our cash flow out of pocket, day one is a $12 million to make a $10 million investment. Again, just paying the tax on that $10 million. We've used the same 10% return, escalated at 2.5% over the 10-year period. You'll note we do not have a tax liability December 31st, 2026. However, we do have a tax liability due upon the ultimate sale of the asset. That tax due is a result of depreciation of that asset over that time period, done at a 27.5-year depreciation schedule, or in fact figured on a 27.5-year depreciation schedule, and then at a 20% capital gains tax rate similar to the opportunity zone tax liability as well. That results in a total cash flow of $11.9 million. Summary of those assumptions is on the next page. Again, the tax event does not occur until the disposition. There is no step up in basis, so that depreciation, or the tax liability due, is on the entire sale proceeds less the disposition. We've sold that asset for the same price of $12 million in 2028, or after a 10-year holding period, for an IRR of 8.47%. Again, just to summarize those numbers, we had a 10.92 IRR on the opportunity zone investment, and we had an 8.47% IRR outside of an opportunity zone. I've got one more slide there that just kind of summarizes the differences between the opportunity zone, or kind of the additional benefits of being in the opportunity zone. You've got that $2 million deferred tax upon the initial investment that you did not pay. We also figured the earnings on the deferred tax up to the initial investment. So this is the $10 million at the IRR rate over the entire holding period. We do pay that tax on December 31st, 2026. As Kyla mentioned, that is a risk for many investors. They may not have the cash flow in that 1 year to pay the. They've already invested those proceeds, so there's not like their sale proceeds that they can pay the taxes out of. So it does result in some additional risk for that tax liability due December 31st, 2026. However, the taxes waived upon disposition is that $1.2 million that we talked about, which would not be due on the asset because, again, the capital gains can occur, or the asset can appreciate capital gains tax-free, essentially. A total of $3.3 million of additional cash flow to investors, and that's the difference you're seeing represented between those IRRs of 10.92 and 8.47%. Kyla, some key takeaways?
Yeah, so just to wrap this up, reminders of a few of the things we've already talked about. One of the big things about opportunity funds is that investors can use the capital gains from a lot of different types of assets, and they're not restricted to only real estate gains. Just a reminder of that important date, December 31st, 2019, is what currently you've got to be invested in an opportunity fund if you want to get that full 15% basis step up. Regulations, they're not final. We've got one set of proposed and further proposed coming, but as of right now, we don't have anything finalized on these. And speaking of the regulations, depending on how an opportunity fund makes its investments, if it goes indirectly through subsidiaries, it may actually be able to meet that 90% asset test with as little as 63% of its assets in qualified opportunity zone property. So these funds will have some flexibility in how they deploy their capital. And our final takeaway, Section 1400Z was written in a way that contemplates future rounds of opportunity zones, which in turn implies that we might have some extension of these deadlines for opportunity funds. And with that, I will hand it over to Jen.
Thanks so much, Kyla. Thank you so much, Kyla and Alan. We're going to start with our Q&A session. Thank you so much for sending your questions over to me during the presentation. I have a few to read now, but please continue to send your questions over utilizing that chat or Q&A section. So our first question from the audience is, help me understand how an Opportunity Zone Fund compares to a 1031 exchange.
So there are a few key differences. The first one we've already touched on is that opportunity funds, you have more flexibility in the types of capital gains that you can use. So you could use gains from a sale of stock, tangible personal property, or real property, whereas under the Tax Act from 2017, 1031 exchanges are now limited solely to gains from disposition of real property. Additionally, 1031 exchanges require that you reinvest all of the disposition proceeds, whereas opportunity funds only require you to reinvest the gains, and that could provide investors with a degree of liquidity since they could sell an asset, retain an amount of cash equal to their basis, and then invest an amount equal to the capital gains, so they're still deferring any sort of tax bill. The final big one, though, is that investors should keep in mind that gains can be deferred indefinitely through 1031 exchanges, and with opportunity fund investments, as of right now, the latest you can defer those taxes is until December 31st, 2026.
One other difference, Kyla, and that is in a 1031 exchange, your gains are compounding. So if you have gains after you roll into a new asset, if that asset appreciates in value, you would also have a tax liability due upon that gain as well. Whereas in an opportunity fund, you would not have a gain on that asset that's held over the 10-year period.
Thank you, Alan. The next question from the audience is, would there be any benefit for an investor to invest non-capital gain funds into an opportunity fund?
We've had internal discussions. I know Alan and I have sat and discussed this, and if it's a good underlying investment that you would have done anyway, which is how we feel people should be analyzing whether or not they're going to invest in an opportunity fund regardless. Yeah, we could see that, but as far as tax benefits, no, there's no additional benefit if it's fresh cash.
Okay, thank you. And then another question that's coming is, what are some of the main concerns with opportunity zones or opportunity zone funds where guidance to date is lacking?
Well, so one area would be there's a lot. As I was going through, you might have noticed there are a lot of definitions that include substantially all. So opportunity zone business must be used substantially all of the time in an opportunity fund or an opportunity zone, but we don't know yet how they're going to define substantially all. Is it going to be 90%, 70%? So I think some of those definitions are a big thing that we're still waiting on because they're going to determine the final structure of some of these opportunity funds.
Okay, thank you. That was our last question from the audience. I want to remind everyone in the audience that we do have our CE course available on AI Insight, and it does include more case studies to review. I also want to say thank you to Kyla and Alan, as well as the group over at Mick Law, for partnering with AI Insight to deliver this educational webinar. Also, thank you to the audience for calling in. Please reach out to Kyla, Alan, or customer care with any questions. Thanks again, everyone, and hope everyone has a great afternoon.
Thank you.
Thanks, Ellen.
Thanks.
Thank you. Bye-bye.